Welcome to our lecture on how exchange rates are determined. This is a short lecture that will try to visualize the basic notion of risk and return, causing money movements across national borders, and ultimately causing currency values to change against each other. Let's begin. An exchange rate is simply the value of one currency relative to another. Think of it as a comparison. How much of one currency you need to get another. When we talk about the dollar versus the euro, we're really asking which one is more valuable right now. Exchange rates are not fixed. They move constantly as conditions change. When demand for one currency rises, its value increases. When demand falls, its value decreases. One of the most important forces behind exchange rates is return. Money naturally flows toward higher returns. Investors, banks, and firms want their money to earn more, whether through higher interest rates, better growth prospects, or stronger profits. But return is only half the story. Money also avoids risk. Political instability, economic uncertainty, weak financial systems, or unstable policies make investors nervous, and money moves away quickly. In today's world, financial markets are globally connected. Capital moves across borders almost instantly. Countries are constantly competing for global money through stability, growth, and credibility. When a country offers high returns with manageable risk, money flows in. When risk rises or returns fall, money flows out. These capital flows directly affect demand for currencies, and therefore exchange rates. Money will ultimately move away from high risk if it is not properly compensated. Short-term investments will be easier and quicker to leave. Money will seek our higher returns across countries and investment opportunities. The balance between risk and return is essential. Risk will always need to be compensated. Exchange rates are not random. They reflect how global investors view risk and return across countries. As money moves toward opportunity and away from danger, currency values adjust, constantly balancing the global financial system. Thank you for watching our lecture video. See you at the next one.